Going into the app, we see right away GME is on top of the short-term bulls. Just going through the top of our signals, I'll just go through them one by one. And the nice thing about it is you can click on any signal and then drag it up and get the more detailed picture of it, right? And so I'm just going to go through the long-term ones first. I'll start easiest. Profitability is just measuring a company on the scale of 2,000 stocks and how profitable the market expects them to be, right? And we'll use EPS estimates by analysts, and then we'll layer in our own kind of simulation technology on top of that. Growth is the same thing, except we're using sales projections instead of profitability. The kinds of things we recommend for profitability and growth for a bull is we like profitability plus growth to be above 120 for a bull, a long-term bull, especially on what you're looking at, and even a short-term one. And ideally for something where we have high conviction on, we like that to be above 130. Market similarity is our version of beta, if that's not a term that you understand. Basically, what we're trying to tell you is how similar a stock is, 0 being completely dissimilar and 100 being highly similar to the S&P 500. Why is that important? Because that helps you understand risk, right? If a stock is at 100 market similarity, it doesn't really do you that much good to own it, right? Because you could own the S&P 500, have, risk control over that, right? As in, if you own, say, a stock with 100 market similarity, right? You are getting the risk of any negative news events for that stock, but you're also getting into a wider base if you own the whole market. So you're not facing any individual stock risks. So yeah, and the inverse is if you have a stock with 0 market similarity, that is where you're getting the most distance from the market, but you're also getting the most risk, right? Because the market could be going up generally, but a stock with a 0 market similarity could be going the complete opposite way of the market, which sometimes you want, right? If the market's going down, a 0 market similarity stock might be going, up a lot. So that's super important. Upside and downside are probably our most complex methods. And I'll kind of, summarize it for you. So what goes into upside is it starts with our core options algorithms. And the core options algorithms are trying to assess in the case of upside, long-term options contracts, the demand for calls above where the stock is trading, right? And we assess demand primarily with price. If calls above where the stock is trading are priced, a lot higher relative to other stocks, right? So there might be some stocks that, at a call 20% above where the stock is trading are trading, 60% above where the contracts are trading for strikes where that company's stock is trading. Or you might have a stock that number is like 120% for, right? So that gives you an idea of where the market's pricing. We also look at, the number of contracts that are outstanding for that. That is one component to it. Then we're looking at analysts, and we're looking at the extent to where their price targets are above where the stock is trading, the percent of buy recommendations for that stock, things like that. And then as well, we're looking at price momentum factors. And for those that don't know, the single biggest variable for stocks to go up the next year are how much they've gone up in the last year. So those price momentum factors can be very important too, right? And our really kind of famous case study of Meta, where it was at 100 upside when it was still trading at 170 and stayed at 100 upside, pretty consistently, and it still is very high until a couple years after that, right? We spotted it really early, right? Because why? The long-term options markets, people were betting that the stock would go up. Overwhelmingly, institutions were, right? Then analysts thought the stock would go up. And then price momentum factors also, started to be in the favor. And all of those had to continue to stay up, right? For Meta to stay at 100 upside for, over a year, analysts had to keep raising their price targets. The options bets had to keep still being live above where the stock was trading. So all that's very important. That's why people ask sometimes like, oh, is this investment still good? The stock has gone up a lot. And the answer is yes, right? Because it doesn't stay at 100 upside unless analysts keep raising their price targets. Against options bets stay live, betting for the stock to go up. That's what makes them so effective, because they can stay live with the market, right? Then downside is kind of the inverse of what I said. Instead of looking at the demand for calls above where the stock is trading, it's puts below, and then everything else is inverse. And what we generally say for longs is we need the stock to be 20 points higher upside than downside. And we prefer for high conviction longs to have the stock be 30 points higher in upside than downside. Now we can get to our short-term signals, right? Our most popular one, kind of our hero metric, what we talk about is net option sentiment, right? Net option sentiment, it's good that we do upside and downside first, because net option sentiment is just crunching those demand equations together, right? So we're looking at, in the short-term options market, the demand for calls above where a stock is trading, and then we net that out with demand for puts below where the stock is trading. We scale that against 2,000 other stocks. So one of the examples, one of our most famous case studies is Tesla, where in 2023, a number of times we timed it perfectly because we saw net option sentiment flatlined to 100. So Tesla had to be the best of all of our 2,000 stocks, and it stayed there. And when we saw it stay there, it meant big things to the stock market. Like in inverses, we've seen in some of the worst moves of the stock market, SPY net option sentiment flatlined at 0. So this is one of our best metrics, and you can look at that together, right? You can tell, like, using that example, if SPY net option sentiment is at 50 and Tesla net option sentiment is at 100, that means very bullish things overall, right? But even if Tesla net option sentiment is 100, but SPY net option sentiment is at 0, that could actually mean that Tesla's going down because the whole market's going down. It's just a bearish market, right? So you need all of this in conjunction with each other, right? And that's our most important signal. Next, probably the easiest signal to interpret, net social sentiment, right? That's just like, is there positive and or negative chatter on the social networks for this stock relative to other stocks? Another pretty easy one is going to be dark pool. But one of the things about our dark pool rating that's important, that makes it different, and you could always read about this in terms of like our dark pool rating versus a lot of other dark pool ratings, which is like, you see things like percentage of stock traded in the dark pool, right? And the big thing about that is that, sometimes you could see a stock that trades 70% in the dark pool, but the volume of that stock is only, say, like 20,000 shares in a day, right? So it's easier to send that volume through the dark pool versus, like, if you think of a stock like Apple, right, that's trading orders of magnitude more in a day, a number like 54% in the dark pool could be a lot bigger. So when we look at our dark pool number, when you see our dark pool number, we are adjusting relative to size, right? So we're basically saying like a 55% dark pool for Apple relative, we do churn, like relative to the total number of shares outstanding is what matters to us, right? Relative to the size of the company. So you can see in all our metrics, we're doing things to normalize things and make what we say is making them simple and information rich, right? And on dark pool, like obviously we skipped over this, net option sentiment, social sentiment, we like them. There's a hard line bull bear. We want them both to be above 50 for bulls, right? We can tolerate a lower social sentiment. It's not a need, but we like to say for any bull pick, short or long, we really like that to be above 70, but it depends on the sector, right? For upside, downside, net option sentiment, you have to benchmark it relative. Like I can tolerate a 60 net option sentiment or a 60 upside, right? If it's in an energy sector, in a financial sector, that's because we're talking about the options markets primarily here. And the options markets, people don't speculate as much on a financial stock because you'd rather own the stock and get the dividends than own the options and bet with options because options don't get you dividends. And that's a very important point of why, something like an energy stock or something, we can tolerate a lower net option sentiment. But, on something like tech, we don't want to see upside or net option sentiment below 70. We just don't. We think that's, really, really risky. And you can adjust and you can kind of look at the, sector averages. We always recommend looking at other sources in terms of like, oh, what are the competitors for this company? Let me check what the competitors are, what their net option sentiment are, what their upside is, because it's important to benchmark, right? If a stock that has a 60 net option sentiment and 60 upside is much higher than its competitors, that's a very important data point for you. So short pressure is the other one we pair with this. Short pressure is like the risk metric compared with dark pool, right? Generally what we say is we don't like dark pool or short pressure to be above 70 because that's like a pretty high risk. And a lot of times we'll filter that out in our investing letter, right? Short pressure, the way it works is just basically it's looking at the extent the stock is shorted, the percent shorted relative to the float. We're looking at things like the borrowing cost of shorting the stock. And just so people know, right, a short is actually a loan, right? You'll short a stock at a certain price, let's say $10, right? And basically what you owe is that plus the borrow rate, right? Because let's say you short a stock for $10 and it has a 10% borrow rate, right? Let's say after a year, the stock hasn't moved at all. It's still at $10. Your position is actually underwater to $11, right? Because you had that loan of $10 plus plus the 10% borrow rate is another dollar per share as a loss, right? Because you have that borrow rate, right? And then when you pay it back, you have to pay back the difference between the stock price and whatever interest you incurred on that borrow rate, right? So in terms of short pressure, basically you're looking at, the higher the borrow rate, right? Because the less shares there are available to short, the number of shares available is another thing, the more you can charge in terms of borrow rate. That's why borrow rate gets very high in a short squeeze, because there's very few shares available to short. And then you have companies that will start to gouge and really raise that borrow rate, right? So if you're looking at, again, similar to profitability and growth, but this is short or long. We would say in a short or long, if dark pool plus short pressure goes above 120, we want to get out because we think that's too risky. At 140, we say definitely get out of almost any position. We might want to hold, and we've held that before, but it's just very risky at that point, because the thing about dark pool is when there's dark pool transactions, it means that basically the market thinks that the price is either too high or too low. And you don't necessarily know if it means institutions actually think the stock price will be lower or higher. So it's just risky. It just adds to the risk. And why short pressure goes both directions, right, is you could say, oh, there's a lot of short pressure, a lot of institutions that want to short this. Hey, maybe that means the stock price will go down. But the other side to that that's risky is if the short pressure gets very high, then you could get a short squeeze and get heavy losses on your short. So that's why we look at those together. The last thing is net institutional flow. That's actually looking at, where, the extent that institutions are betting on a stock in terms of the number of shares that they buy, right? Shares and options, but it's kind of the sheer size of it. So there's things that we do to control for size, but actually the larger the company you are, the more likely you are to have a high net institutional flow, because we're just looking at raw dollars in relative to other companies.